amazing. So we're ready now for the next panel. I know we've got a couple of talks after that as well, and some of you wanted more spicy conversations. So we've got Mickey Graham now, who's going to be rolling on and talking about the future of tokenized yield, along with his gang of really, really talented people. Mickey, I'm going to let you take over. Thank you so much, everybody, and all the best, everyone.
Thank you. Test 1 2 1 2. How's the mic volume? We good? Awesome. Well, thank you everyone for being here. My name is Mickey Graham. I am the co-founder and general partner of MetaLayer Ventures. We are a $25 million early stage fund focused on the intersection of traditional financial services and the on-chain economy. With me, I have three great founders who are pushing forward the future of tokenized yields, coins, RWAs, and institutional DeFi. So I'll let them introduce themselves, and then I'll add a couple words on top of that. Go ahead, Will.
Hi, everybody. Will Beeson. We're building a company called Uniform Labs, which is liquidity infrastructure for tokenized assets. So our thesis, I suppose, is that ultimately much of finance, including securities, including financial markets, will be re-platformed on-chain. If we look across the spectrum of assets which are currently available in token-native form, there are some very high-quality assets, but the access to these assets and the ability to subscribe and redeem is often constrained by TradFi payment rails or settlement cycles. And ultimately, for the shared vision of on-chain finance to flourish, we need to deliver instant convertibility, instant settlement in blue-chip tokenized assets against tokenized cash in the forms of stable coins and ultimately tokenized deposits. Uniform Labs is building that infrastructure. Our liquidity layer is called Multi-Liquid. It's live on Ethereum mainnet today. And it supports instant liquidity in blue chip assets like money market funds, private credit, and private equity.
Hey, great to meet everyone. This is Abhi. I'm one of the founders of Theo Network. We're an end-to-end tokenization platform focused on bringing high yield, low duration credit products on chain, starting with money market funds and then moving into structured products. And the focus for our business is, we want to make RWAs available on chain, high quality RWAs on chain, but also make them liquid, tradable, and available across most environments.
Hi everyone, my name is Sonya. I'm one of the founders at 3F Labs, building 3F protocol, which is currently being developed. We're probably going to go live in the next month or so please make sure to follow us at 3F_XYZ on Twitter. You may have seen this week, there was a lot of chatter on Twitter about RWA looping. Perhaps it's the bear market and tokens are down and people are starting to look at real yields. What we're trying to do is allow people to gain higher real yields through leveraging RWAs, except we're trying to not do that through looping, which we believe is the most inefficient way for non-atomic assets. So happy to go into it later during our Q&A, but yeah, we definitely want to kill looping altogether for RWAs. We don't think that that's the most UX-friendly way of gaining leverage carry yields for investors.
Thank you so much. So the thing I love about this panel is that we basically have the full stack institutional tokenization and DeFi future represented on this stage, starting with Will, who's building the base layer and interoperability infrastructure, Abhi, who's building full stack infrastructure for bringing tokenized products into the blockchain, into blockchain-based systems, and Sonya, who's building on-chain institutional primitives like prime brokerage and leverage. So between the three of them, you can kind of imagine what happens when you bring RWAs into blockchain-based systems, add instant and deep liquidity, and then be able to bring leverage to build better strategies. So we'll unpack each one of those things kind of individually and really get a glimpse into what this future looks like. So to kick it off, I think we would all probably agree, maybe Abhi not fully, that we've largely solved issuance. So what's holding back the broader adoption of tokenized products? I think Will would probably say liquidity. It's okay. We can share that. We can share our mic too. So I was going to say we will kind of dive into each of those. Liquidity is one answer that Will would say, but I think access and compliance might be two others. So let's start kind of with those topics. So Will, I will pass it over to you, and I would love to hear a little bit on why liquidity has been such a persistent barrier to adoption. Kind of why is it difficult to solve, and what does it unlock?
Sure. So maybe immediately pointing to the constraint when it comes to tokenized assets today. We all live in an on-chain world, or at least aspire to. Crypto assets are natively atomic 24/7 because they're on-chain. If you issue a financial asset, a security, as a token on blockchain, you expect the same experience. But that's not the case. Because to initially invest in one of these products, what you have to do is maybe you take stablecoins, maybe you send them to an issuer. The issuer, in order to buy real-world assets, off-ramps that stablecoin into fiat, which takes time. They then purchase an off-chain asset. If it's a security, then it settles based on traditional security settlement cycle, so maybe T+1 if it's a treasury. At that point, 2 days later, they have the treasuries in the reserves of the fund, and they can issue the token. So you've basically spent 2 days out of the market investing in this product, and then if you want to get your money back, you redeem back to the issuer, and it's the same T+2 process because you're basically unwinding the same flow from before. So in a given week, to get in and out, you're basically out of the market for 4 days. Those are business days, by the way, because none of this happens on weekends. So even if you have a whole week to invest, say, excess stablecoin liquidity into a high-quality yield source, you can't do it. So then who are the buyers of these assets? Well, right now the buyers of these assets are effectively like kind of long-only buy and hold. Maybe they're treasuries, maybe they are protocol reserves who are purchasing high-quality yield sources and basically holding them in perpetuity. So that doesn't immediately translate into secondary markets, into liquidity, into buyers on one side, sellers on the other, which means that there's effectively no way to quickly enter and exit a position in any of these tokenized assets. So fundamentally, that's where the quote-unquote liquidity issue comes from and why there's no liquidity in these markets. So how do you solve for that? It's a combination of two things, I think. The starting point is basically create the infrastructure, the connective tissue, which allows for buyers and sellers to be able to seamlessly interact on secondary in these assets. And then secondly, you need to plug into enough use cases where that instant settlement nature of the assets is an unlock. So things like DeFi lending, things like collateral management across multiple venues that can only happen in a blockchain context, but that solve real world problems, and kind of as a byproduct create that demand for instant settlement, secondary venues for these types of assets. But I appreciate it's a bit philosophical, but ultimately that's kind of the state of play when it comes to liquidity today. And I think that the final, I guess the next stage of the market, which we see developing, and I think Abhi can confirm if it's what he's seeing as well. But basically, instead of taking the tokenized asset to market and looking to place it with a buy and hold investor, to take the tokenized asset plus the liquidity availability to market as a joint offering. So now the buyer is buying an asset with the expectation of liquidating it instantly, because it's a part of the use case, or it's a part of the workflow that they're building. And we think that change, that upgrade in terms of the go-to-market in a lot of these assets is ultimately what's going to start this liquidity flywheel, which will generate demand for more liquidity, which will generate more instant liquidity-based use cases, and ultimately help realize really the value proposition, the whole point of tokenizing assets and bringing them on-chain.
Yeah, and I want to double click on this really quickly before we kind of move into other tokenized products that Abhi and Sonya are building and kind of where we see this future going. But I think one thing that I've been wrapping my head around is that these institutional tokenized asset issuers, think BlackRock, Fidelity, Franklin Templeton, Wellington, they all need KYC users on these products to drive liquidity. So I think it's important to talk about permissionless versus permissioned DeFi when we talk about institutional DeFi. So I'm curious, are we building kind of two separate systems here where all of this liquidity will need to be KYC to interact with these institutional products? Or is there a way that we can be repackaging some of these institutional assets into more permissionless DeFi primitives?
Well, I look forward to Abhi's answer on this because I think it's very squarely in his wheelhouse. But it's very obvious to me that we're building one system because these assets are now available in self-custodial wallets, right? Like, I think at the highest level, even taking a step back from there, it's like traditionally we live in a world where an account is effectively a balance that that is maintained for you at an institution. An institution holds that account for you, maintains it for you. I think that the future state is one where your wallet is your account, and you are the account owner, and you take that account to multiple institutions that can interact with them in different ways. Some of those institutions can be centralized institutions that we're used to today. Some of those institutions can be DeFi protocols, can be new form of financial actors. And I think that is kind of one answer to the question of what's the interplay between the traditional financial system as we know it and the existing actors and DeFi. And so I think we end up with a kind of blended end state. And then when it comes to the assets themselves, I think we will definitely end up in situations where certain venues, certain assets, certain use cases are fully permissioned, fully KYC'd, and other types of use cases. For instance, where you can separate the kind of economic value flow between which needs to sit between regulated, potentially regulated firms, but certainly known entities. Separating the value flow from potentially the provision of some of the services around that value flow. And I think some of the services you can do on a permissionless basis, even against a permissioned asset.
Yeah, that's great. And I'd love to hear Sonya and Abhi's thoughts on this, specifically kind of how we can take permissioned assets and products and reformat them via vaults and other mechanisms to adopt or more retail liquidity.
Yeah, so I guess the way I kind of think about the market is there's definitely a market for regulated KYC only instruments, and those are primarily compliance friendly, right? So I think the real advantage from KYC, single wallet holding, non-transferable, it's primarily if you're managing a treasury or you're holding assets on chain because you have somewhat of an on-chain business, but you're not really active in the DeFi ecosystem. You're not trying to maximize yield or rotate capital quickly. You're better off holding it in a KYC account because it's compliance friendly. It's easier to manage the actual regulatory overhead, especially with the compliance department. But I think that the primary growth that we're seeing in RWAs is in the non-KYC wrapperized or pass-through type tokenized products. And the strategic advantage there is, and when you think about the customer base in crypto that wants to invest in RWAs, it's primarily yield-seeking, opportunity maxing entities. So it's funds, large traders, token holders. And what they're looking to do is one, they're looking to find the best rates, find the best products that they want to hold, and rotate between them, but also leverage them using vaults, lending protocols, etc. And those lend themselves a lot better to non-KYC'd assets and tokens because if you want to borrow money against assets, you need to be able to liquidate them instantly. You need to be able to exit them quickly to rotate to new products. And so having liquidity and having the ability to transfer is is definitely a huge advantage, and it's a much wider market than just a KYC or like not non-transferable assets that were the original RWs that came into the market.
Yeah, and Sonya, anything to add here?
I'm not a lawyer, so from a legal perspective, I'm not really sure what's, technically legal or illegal, or just, right now we don't really actually have a framework for what is legal or illegal in many of the DeFi related activities, because the regulatory regime hasn't caught up to yet what we're experimenting in DeFi. But one thing that I thought was very interesting that is happening, at scale is the model that Sky ecosystem has taken. So for those of you who are not familiar, Sky is the largest decentralized stablecoin. They have USDS, which one can stake to earn the yield of the allocation system that the sub-DAOs, enable, and each of the sub-DAOs, their remit is to generate yield or best yield on a risk-adjusted basis. From what I can gather, the way the Sky ecosystem has navigated this friction between permissionless DeFi and KYC, needs of the institutional products that some of the sub-DAOs are investing in, is that they make sure that there's a separation between the minting function and the allocation function. So the minting function, happens at the DeFi level. It's permissionless. Anybody can come and mint the USDS. But at the allocation level, and some of the sub-DAOs are investing into these regulated KYC necessary products, that the sub-DAOs are the ones that are KYCing and are eventually getting the reserves from the Sky ecosystem, USDS minters. But it is very necessary that there is a clear separation between the minting function and the allocation function in order for this to be seen as I guess legally compliant. So I think there's interesting structures and experiments going on to merge these two worlds, which are inherently at odds with each other. But this is kind of an experimental territory, and I like that this is happening, in real time at scale, and we'll see how the regulators view, if and when they catch up, this sort of activity and the marriage of the two different worlds.
Yeah, this is so fascinating to me. We at MetaLayer were investors in Athena, and I think one of the reasons we were really excited about the protocol was the idea of a tokenized structured product represented as a synthetic dollar. I think we've seen the explosion of the basis trade, but that's kind of just scratching the surface for how we can package all sorts of novel yield into different instruments. I think Abhi and Sonya are really on the forefront of kind of experimenting with what else we can do. So I'm curious from Abhi and Sonya's perspective, kind of what is on the horizon in terms of some of these novel tokenized strategies represented as synthetic dollars.
Yeah, so I think that's a good point you brought up. Athena kind of showcases like what the market is looking for, which is primarily low duration, mid to high single digit yields, and like easy access to liquidity. So, I mean, technically Athena, I guess, is a synthetic dollar, but really what it is it's a very liquid, very low duration bond like yield like product, money, almost like a money market fund, and that's what made it so popular. And what customers are looking for now in the ecosystem is something similar, that they can kind of enter with cash that maintains a dollar peg, that they can exit quickly if they need to access other opportunities, that has deep liquidity on chain, that can be leveraged and looped if needed to basically enhance yields. And I think that looking on chain today, there isn't that many like crypto native yield sources left that can enable that. And so I think a lot of and I think that's healthy, because obviously crypto native yield is generated primarily from leverage trading and kind of unsustainable source. It's not productive capital at the end of the day. And so as that market scales up, like functionally the yield has to drop. And we're seeing that now. Like crypto native yields are like averaging 3 to 4% around the treasury yields, short duration treasuries or money market yields, which is kind of where we expect them to land, since it's unproductive capital. And so some of the things that we're looking at Theo are finding ways to deploy capital in low duration strategies that generate mid to high single digit yields. Currently, we're focusing on products like gold and like borrowing, lending gold and then hedging that. Looking at other commodities markets as well to target that high single digit yield that's low duration, that's liquid on chain, that lets that functions somewhat like a money market with a little bit of an added risk, but that gives the customer the opportunity to generate that yield, but also exit their position quickly if they need to. And I think like that's kind of like where I see the growth in RWAs today, which is like, sure, there's a lot of these like counterparties who want to hold and just buy and hold for a long period of time, like let's say like longer duration debt or instruments like that yield that are higher yielding, but they primarily don't. They could just do that off chain too. Like funds or funds or institutions that want to buy debt, they can go to access that through OTC desks or banks, etc. What's really more interesting, I think, for users on chain is like, can we find high yielding instruments that are actually low duration? Like that's actually so that they can kind of wait and see when there's opportunities in crypto to rotate out of those products and back into crypto native yield sources.
Yeah. And Sonya, how does 3F think about this?
Yeah, I think for us, all the assets are going to be on the blockchain at some point, right? All the assets that we hold right now off-chain will come on-chain, and we've seen the market cap of RWA assets this year go parabolic. But what's interesting for us to think about is, what can you do with these RWAs on-chain that you can't do off-chain such that it compels a user to buy that asset, right? We're talking about new forms of utility that are uniquely enabled by blockchain rails. In that regard, 3F is enabling leverage on RWAs. This is a form of leverage carry trade. So, for instance, if you buy say Janus Henderson's AAA CLO, which yields 7%, and then you can borrow against that on, say, Morpho or Aave, at a rate that's lower, say 4%. You have a 3% spread in between the asset you own and the borrow rate against that asset on chain. And you can keep doing this, loop it over and over again to pump up your real yield. You can't do that off chain. If you have a CLO fund by Janus Henderson, you go to your banker and say, hey, I want to use this as collateral and borrow money so I can buy more of this collateral, and then you pledge that collateral to borrow more money to buy more of this asset. No banker is going to give you this loan because, who knows what you will do with this loan, right? It's kind of like the 3AC situation all over again. If, the CFI lenders of 2021, when they lent 3AC bunch of money, and it was in their discretion to do whatever they needed to do. So what's amazing about blockchain rails is that the money flow is completely visible, and we have this unique opportunity to allow leverage carry trade on yielding assets all on chain. As I mentioned briefly, looping, however, for non-atomic assets with delayed settlement is a total pain in the ass. If you were to, buy the asset, collateralize it on a lending protocol, borrow against it, then buy the asset again and loop it, each loop can, take you the liquidity cadence of the underlying. And if your, underlying is like T+1 even, to do 30 loops would take you like 30 days to build up your trade and then 30 days to unwind, which is poor UX. So our workaround is that fully on chain, there'll be liquidity providers who bridge the gap. So if you wanted to 5x leverage the Janus Henderson CLO fund through 3F, there will be, with 1 million capital, there will be a prime broker who gives you an upfront loan of 4 million. So together, the 5 million can be deposited into the tokenized fund. The tokenized fund then gets collateralized on a lending protocol such as Morpho. You can draw a loan against that collateral to pay back the prime broker. And this is all going to be automated through the 3F protocol with one click. And this is a use case that's only enabled through blockchain rails, thanks to some of the earlier innovations of our friends at Morpho and our friends at these like tokenization agents. So we're really excited about finally being able to compose all of the things that we've collectively developed as an industry to be able to uniquely enable a new source of yield, like Abhi said, that is not possible off-chain.
Awesome. Well, we could really talk about this all day, and it's incredible to see where the future of this market is going. But I think we're at time here. So can I get a huge round of applause for Abhi, Will, and Sonya? Thank you for joining us.
Thank you for having us.